Respected CAI Krishnakumar, senior members, past chairmen, members and my dear friends. I wish you all a hearty good evening. It gives me great pleasure in welcoming you all for the CPE seminar. We are indeed fortunate to have amidst us CAI Krishnakumar, who has been very kind enough to accept our invitation to address our members on the topic recent issues in TDS. I have great pleasure in welcoming you, sir, in this wonderful seminar. I also extend a very warm welcome to all the past chairmen, senior members and members. Thank you.
To address another CPE program at our Erode branch, I thank our chairman and managing committee for this opportunity given to me. So today's topic is recent issues in TDS. Last week our senior member had handled recent case laws in income tax. So I have restricted my presentation to the recent changes that have been brought into by the Finance Act 2015 with respect to TDS and a few interesting case laws where the provisions of TDS were dealt with. There are a number of amendments in TDS brought out by the Finance Act, which has been passed by Lok Sabha as well as approved by the assent is given by the President also, it has come into effect. We shall see some of the important amendments in TDS which will have a direct bearing in our line of practice. There are certain areas, there are amendments in TDS which we will not have any relevance. So one of the main issues is section 192. So the amendment here is the person responsible for making payment, that is the person who makes payment of salary, at the time of estimating the income of the assessee, he is under an obligation to call for the evidence or proof of particulars which the employee wants to include in his computation of tax liability. So he cannot just give an estimation of how much investment he can make under ATC, ATD or whatever may be the sections. So he has to give the evidence or proof in the prescribed form and prescribed manner. This includes claiming of loss also. That is, if he claims any loss under the head house property, he is supposed to give interest certificate, and for the principal repayment he has to give how much principal he has repaid. Only based on that the employer can deduct TDS. Here some issues will come because in the beginning of the financial year the banks will give only the provisional certificates for deduction under section 24. We can take interest on accrual basis. It need not be paid for claiming deduction under section 24. But as far as the principal is concerned, only the amount paid can be considered under section ATC. That will be known only at the end of the year. So maybe some cut-off date is given like the 10th January or 10th February. Only up to that the employer will be able to consider the figures for arriving at the TDS figure. So employer need to be very careful in order to avoid penalty. 192A, this will have only very less relevance I think in our place. As far as the PF is concerned, now it has been brought under TDS, but some relaxations are given in this. So whenever there is a withdrawal from accumulated balance in provident fund, tax liability should be made by way of TDS, should be discharged by way of TDS, drawing from a recognized provident fund. What are all the concessions given in the TDS is that is there are some relaxations given for non-deduction. Those are, if this PF is not includable in his total income, TDS will not be attached. That is, if it is after 5 years, then it need not be deducted. Similarly, if the amount withdrawn is only up to 30,000, again TDS need not be made. Again, the employee is eligible to give section 15H or 15G under section 197A also. So these are the relaxations given. If considering all these things, still he is liable for, his income is liable to be included in this accumulated PF, then tax is to be deducted at the rate of 10%. In the absence of PAN, the rate will be the highest maximum marginal rate. Section 194A. There are 3-4 important amendments that have been brought into section 194A. The first one is TDS on interest paid by the bank, cooperative society or public company. So far, the limit of 10,000 or the 5,000 was considered only at the individual branch level. So the software, CPE software of the banks or the companies were also designed in such a way that if the payment in a particular branch does not exceed the 10,000, TDS need not be deducted. With the same customer ID, if he opens another deposit at another branch and there he earns 8,000, in the first branch he earns 7,000, total interest is getting from that entity maybe more than 10,000, but TDS was not deducted till before this amendment. But now the amendment has been brought in such a way that irrespective of the branch, if the entity pays interest of more than 10,000, they are supposed to deduct TDS. So just like PAN number, the customer ID, if the customer ID earns an interest of 10,000 from whatever may be the branch, the payer of interest, that is payer of income, the banks or the public sector company or whoever it is, they are liable to deduct TDS. But only one aspect is that they must be adopting CPS. Otherwise, it will not be practical for them to combine the interest earned by a particular depositor. So, if the CPS is not adopted, then this provision will not be attracted. But if CPS is in vogue, they cannot deny liability on this count. Then no TDS by the cooperative society. This is second amendment that has been brought in. This is also clarificatory in nature. Here they have given that TDS is not applicable for interest credited or paid by a cooperative society other than a cooperative bank. So this other than a cooperative bank, now it has been made clear. So they are also brought into TDS net. Any cooperative bank is also liable to deduct TDS in same lines as that of scheduled bank. But a cooperative society need not deduct TDS if it makes payment of interest to a member or to another cooperative society. So this is with respect to TDS of cooperative society. And the MAC cases, motor accident compensation, claims tribunal deposits made, they have made a change of, instead of credit, because the deposit, the amount may be deposited for a particular period of 3 years, 5 years, based on the directions given by the tribunal, MAC tribunal. So, as per the 194A section, TDS is to be deducted at the name of payment or credit, whichever is earlier. So, there comes a problem of filing in whose account, in whose PAN number it should be filed, or whether the amount will be refunded, or all these problems crop up. So, in order to make that very clear, now they have made a relaxation stating that this is an exception to the general provision that TDS can be made. It is not, it can be. It is sufficient if the TDS is made at the time of payment of interest. They need not make TDS at the time of credit of interest to the account. The deposit may run into 3 years or 5 years, depending upon the directions of the court. And still, this 50,000 limit is exists. So up to 50,000 of interest, in the regular cases it is only 10,000, but here it is up to 50,000. So they need not deduct TDS up to 50,000 also. Now the recurring deposit is a new item which has been brought into the TDS net by this budget. Till date only the time deposits included, fixed deposits, accumulated deposits, whatever be the nature, excluding recurring deposits. So most of the banks have canvassed a huge amount under the recurring deposits. Now that has been brought into TDS net by the bank, so it will be a huge task for us also to ensure that because number of even small number of RD amount may be small, but the number of accounts may be huge even for a particular single depositor. So either 15H or 15G or TDS PAN number is mandatory. We have to ensure that the compliance is made in this count. So 194C. Only a few years back, the ambiguity with respect to payment of amount to the contractors was transport contractors was addressed, but now again an issue has been created, I think, in this budget. So now the condition is that no TDS for the sums paid are payable to a transport contractor. The condition is that he should own 10 or less goods carriage at any time during the previous year and furnishes a declaration to that effect along with his PAN to the payer. So this condition, how the assessee is going to fulfill and how we are going to take whether this condition is fulfilled and how we are going to report in our what are the TDS deductible, whether TDS deducted or not, that we have to form an opinion based on the information available. And declaration, yes, declaration. Only TDS.
Declaration in the format, sir.
No.
Is there any format to declare 10 or less?
No. Furnisher declaration means I declare that I own only a self-declaration. Self-declaration, but we don't know whether the person who is making declaration is owner or lorry driver.
Any proof we will get?
RC book we must ask.
That's what I'm telling you. Some ambiguity was.
Sir, it is a self-declaration by the owner of him, sir.
Yes.
He is more than 10, he is liable for that.
Correct. Like 15H and 15G, we are, if an assessee gives a 15H and 15G. But the thing is that whether we can get the declaration is the question. Because if he comes in midnight and he drops the goods and gets the payment, he goes away. We do not know who dropped or. Yes. No, we might have made payment also.
Payment, you will directly access that. After you will give the proper activity.
Regular supply,
We can get it, yes. Once we get, then we can use it for the entire financial year. That we have to see. Because the assessee may have to pay service tax also on reverse service. Now it has been brought to 30%. Now the TDS, if you don't get proper declaration along with this PAN number, then he may be in trouble. This is an amendment in 194I, which will have only little impact, I think, in our line of practice. So no TDS for rent paid or credited to a real estate business trust referred to in section 1023 FCA. So 1023 FCA, they have given exemption. If you are making payment of rent to that notified trust, TDS provisions are not affected. This real estate business trust is also given some other exemptions in TDS. Since it is of not that much relevant, I have dealt with only this much. This is one of the major amendment which will have a serious impact to all our clients. Regarding section 195. 195 deals with the deduction of TDS in respect of payment made to the non-resident. So whenever we make payment to the non-resident, the assessee will go to the bank, he will submit form A1 or A2 depending upon the nature of payment, he will make the remittance. Previously, before this amendment, only the items which are liable to income tax, to which the non-resident is liable to the income which is deemed to occur or arise in India, for which he is liable to deduct TDS, the assessee has to obtain a certificate from the chartered accountant and submit to the banks as well as to the income tax authority. Last year, the format of obtaining certificates were changed. 15CA and 15CB forms were introduced. online filing was also introduced. So some of the bank, even before this amendment, were insisting for the certificates from the chartered accountant, even for making import payment. For import of goods, if you are making any payment, no tax liability is involved. But still some banks, due to the reason for insisting on that certificate was the ambiguity of circular issued by the CPE. But now they have made amendment in the section itself stating that irrespective of the question whether the payment is liable to tax or not, the person who makes remittance has to report it to the department. So it is nothing but 15 CA and CPE. Without that, penalty will be attracted by the assessee. Section 195(1) provides that any person responsible for paying any interest or any sum chargeable to tax to a non-resident, not being a company, or to a foreign company shall deduct tax at the rates in force. Actually, 195(1) deals only with the person who is liable to deduct tax in respect of taxable remittances made. Next. But the main purpose for which the information is called for is for the two reasons. One is to see whether tax is deducted at appropriate rate. Next one is identifying the transactions on which tax was deductible but was not deducted. It is just like a TDS reporting which we are making under 44 AB report. What are all the items? Irrespective of whether tax is deductible or not, for all the expenses we have to give what is the total amount incurred. Whether TDS liability is attracted, if it is not attracted, we are going to put under not attracted column. Like that, the foreign remittances also, these are the main two purposes. But in the present system, the assessee submits the information in 15 CA/CP only in cases where tax is deducted. So, government is unaware of the all other transactions for which no certificate or information is submitted. If the assessee himself decides the tax is not attracted, then government also will not come to know whether tax is there or not. In order to overcome that lacuna in provisions, they have now modified it and changed that any remittances made should be informed to the department. So the present reporting caters only the first purpose. It is proposed by the Financial Provisions of 195 Act in effect from 2015 to provide that the person responsible for paying any sum, whether chargeable to tax or not, to a non-resident, not being a company or to a foreign company, shall be required to furnish the information of the prescribed sum in such form and such manner as may be prescribed. So this impact will be more in Erode, Tirupur and all other places where there is a huge export is taking place. For each remittances, they will come to us for 15 CA and 15 CP. We have to give all the particulars. We have to fill all the columns of the form, and some of the forms are also need to be e-filed. So the workload will be more regarding this, and the accuracy of form and correctness is also required to be ensured. Since the 15 CA and CP certificate, we cannot give just like that about anything and everything is given. We have to call for all the documents, related connected documents. Based on that, we may have to issue certificate.
Sir, in Tamil Nadu, mostly e-accounts, comedy accounts are Aadhaar transferring money from Dubai and other places. And Erode we can gather. Also, so far they are not taking any TDS transaction.
Okay.
Even 1 lakh, 10 lakh, they had deposit 1 lakh rupees, it will come. It is to be taken by that person's father-in-law or father. This is a major issue for them. That the interest also they have to direct tax from there.
Yes, deduction of interest is another aspect, and this is the remittances which are making from here to abroad.
Yeah.
Whatever be the remittances, say for example, if assessee's son is studying in abroad,
Yes.
we are remitting for living expenses, or we are going for tour.
Even education expense also.
Yes, any remittances, whether it is chargeable to tax or not, living expenses, educational expenses, or if our customer puts a stall in some this thing in abroad, in the trade fair, whatever it happens, whatever remittances, normally commission and other things, there may be doubt whether the tax liability will arise or not. But here they have made it a point that you need not worry about the chargeability to tax. If you make a remittance, you have to give us a certificate. submit in the prescribed form. So without that form, now the AD banks will be instructed not to accept the payment. So if they come in the 11th hour for making a payment, so they will be stuck up. Then we have to give all the certificates. Only based on that, it will be further processed with the remittances. So in order to ensure that the certificate, the compliance, the information part is properly complied by the assessee, they have also simultaneously introduced the penal provisions under section 271I, where they have made that non-submission or inaccurate submission of information required to be furnished in respect of remittances are liable for a penalty of 1 lakh rupees. So they are under the assumption that any remittances made to abroad will be not less than 1 lakh. Even if you make a remittance of some $100, we may end up paying a penalty of 1 lakh for non-filing of relevant information. So they are under an assumption that any remittances will be of higher amount only. So 197A. 197A deals with providing submission of form 15H or 15G to the deductor for non-deduction of TDS. Now, the scope of 197A has been extended due to the corresponding amendment made in some other sections. In the last Finance Act, section 194 DA was introduced, whereby life insurance companies are supposed to deduct TDS at the rate of 2%, where the payment made is in excess of rupees 1 lakh to the life, the person who has assured his life. So now they have made, the department has received a lot of representation, since there may be cases where the income may not be liable to tax. So 1 lakh amount is, it is a small amount considering the life insurance policy. So now what they have made is, apart from the basic limit which they have given in the section 194 DA, they have made this section eligible under section 197A. The person, if his income is not liable to tax, his income is below the limit which is chargeable to tax, he is eligible to give 15H or 15G to the insurance company. Based on that, insurance company will not deduct TDS, just like interest on bank deposits. This 192A, which we just saw about withdrawal from provident fund accumulated balance before 5 years. There also, if the assessee is not liable for tax during the relevant financial year, he can very well submit form 15G to the employer for non-deduction of TDS. These two sections. And there are some issues I would like to get clarified by the members. In some cases, 15G are submitted by the trust to the bank for the purpose of non-deduction of interest. What was your experience in those cases? Some of the banks do not accept it. But actually 197A gives that any person other than a firm or a company. But in some banks, they insist to get a no deduction certificate from the ITO. But 197A, if we see, it gives only other than firm or a company, all other persons are eligible to give if their income is not chargeable tax. A trust is there, it doesn't have any, maybe it has an income of around 1 lakh only, it gets an interest income of some 15,000. So if it goes and gives 15H, and it is also approved under section 12A or 12AA. So there are some practical issues regarding 15. Some of the banks, no, Indian Overseas Bank, even in one of my clients' case, I think in Bhawan or Kumar, that bank doesn't accept. They say only if you get some TDS certificate from. Correct, that is the problem. But yes, actually, as per provision, it is there. We can submit 15G. We can submit. Yes. Cannot give. Rest all can give. Yes. Yes. Firm or company is not eligible for that. And this is another important amendment made by this Finance Act. with regard to payments made by the governments on various business transactions, the tax is deducted by them, but they don't make payment of tax as the normal assessee pays. They pay only by the book entry. What happens is they pay by book entry, and at the time of filing the returns, they are supposed to file Form 26G to the department in time. But there is a delay in filing or delay in submission of particulars from the lower level to the next authorities. The contractors and other persons who do business with the government, they don't get the credit which they are supposed to get in time, due to which there is a difference in TDS claimed by the assessee as well as the TDS approved by the traces. So in order to set right these anomalies, new subsection is introduced which provides that an office of the government where the sum deducted in accordance with the provisions of this chapter, that is TDS chapter or section 192 1A, has been paid to the credit of central government without the production of a challan. The pay and accounts officer or the treasury officer or the check drawing disbursing officer or any other person, whoever it may be, is responsible for crediting such sum or tax to the credit of the central government. Yes, now the responsibility is fixed. Next one. And what they should do, that person is responsible for delivering to the prescribed income tax authority, that is this ETDS filing, or the person authorized by such authority, a statement in such form verified in such manner, similarly to our ETDS return. Now, to ensure compliance of this obligation of filing the statement, they have also amended 272A, capital A, with effect from 1/6/2015, so as to provide a penalty of 100 for each day of default, during which the default continues, subject to the limit of amount deductible in respect of which the statement is to be furnished. So now the penalty clause is also introduced. We may expect that complaints of expected level may come in the future. Computation of fees payable under section 234E at the time of processing TDS statement. So 234E has been introduced in the Finance Act 2012 to provide for levy of fee for late furnishing of TDS TCS statement. So still there are different views whether 234E can be levied, whether whether any service is provided by the government for collecting this fee, that is one issue. So some courts have held that it is not appropriate, and some have allowed it. So that itself is in trouble. In 2009, they introduced the section 200A, in which the processing of TDS returns are dealt with. So in order to accommodate this 234E in the TDS assessment itself, they have made an amendment whereby the provisions of section 200A of the Act is amended so as to enable the computation of fee payable under section 234E while processing the ETDS statement itself. The fee, if any, payable under section 234A will also be computed, and if any demand is there, it will be generated, and if any refund is there, that will also be made available to the SC. So, to separate these things, now 234E is also included into the processing of ETDS statements. So now the amended section provides that statement of TDS made under section 200 shall be processed, and some deductible under chapter 17 shall be computed, after also taking into account the fee, if any, payable under section 234E. So while processing the statement, if any fee is payable by us due to delayed filing of ETDS statements, that will also be included in the processing, and we may get a demand notice for the delayed filing. Some payable or refundable shall be determined after adjusting the aforesaid computed sum against any amount paid under section 200 or 201 or 234E, and any amount paid otherwise by way of tax, interest or fee. After adjusting all these things, they may pass an order making a demand or granting a refund. To the report. So that is option number 203A and
Now I think
assessment itself. That was not included, 234E was not included in the processing. Whether there is delay in filing of return, other thing. No, whether there is delay, we have to give all the details. 234E is paid or not there. So another amendment in respect to TDS provisions is section 203A. So where it has been made that the provisions of tax deduction obtaining TAN number shall not be applicable to such persons as may be notified. So there are certain cases where, say for example, acquisition of immovable property, a resident transferor is supposed to deduct TDS where the consideration involved is 50 lakhs or more. And similarly, by acquisition of immovable property from non-resident by individual or HF. In such cases, obtaining TAN number and filing of TDS returns may be difficult on the part of the individual resident associates HF. So, in order to mitigate these difficulties faced by the small time associates, they have made a provision that they may notify the class of persons who need not obtain TAN number, maybe one-time transaction. It is sufficient if they provide the PAN number of the recipient or something like that, they will, if they find it is sufficient. So this is 203A. So I have dealt with only 2 cases which I thought relevant to this topic. So, and interestingly, both the sections which are dealing with are covered with the same case itself. So this case law is repeated only once, but it covers 2 sections. Under 194C, payment for supply, erection and commissioning of lift. During the course of survey, it was found that a certain amount had been paid to Mr. K without deducting tax at source. So AO felt that tax was deductible under section 194C at the rate of 2%. Assessee pleaded before the AO that payment did not come under the works contract and it was only a contract of sale. So placing claims on the judgment of Honorable Supreme Court, it was said that contract for carrying out the work of supply, erection and the commissioning of lift was a contract of sale and not a works contract. So the payment was not liable for TDS. Consequently, the interest charged under section 201(a) are also deleted. And in the same case, another issue was also involved, and it is quite interesting. So the assessee had debited expenses in profit and loss account. I think there is a repetition of the word under the head. Excess payment refund. The nomenclature used to be as it was excess payment refund. The amount were around 31 lakhs for one assessment year, and for the next assessment year it was 43 lakhs. Thus, assessee had not made any TDS, but he has claimed as expenditure in profit and loss account under the head excess payment refund. But the AO was that TDS is attracted, so he has made a demand on that count. For that, the assessee submitted before the lower authorities that the reason for making such payment was given as such. Some payments were received by the assessee from customers who initially booked the flat by making advance payment plus 1 or 2 installments. But due to various reasons, the customers could not fulfill their payment schedule and they requested for refund. After a certain period, the assessee, that is the builder, identified some new customers and the flats were sold at higher rate than the previous price. So after the sale, the assessee returned the payments received from the previous, the customers who booked first, with a margin in order to maintain a good relationship. And no TDS has been deducted. However, the assessing officer observed that the expenses debited to the P&L account cannot be treated as a refund, and on the other hand, it is a payment of interest on the amount paid by the original customers, which is liable for TDS under section 194A. So, which was decided the amounts were paid in respect of an obligation in respect of purchase of flat through agreement. Therefore, no fault could be found on the part of AO for treating these charges as interest and liable for TDS under section 194A. So, it is liable for TDS. So, the main issue which I thought would be relevant to highlight here was the mere fact that the assessee did not choose to characterize such payment as interest would not take such payment out of the ambit of definition of interest. So, it is not material than what nomenclature the assessee used in the profit and loss account or in his books of accounts. In so far as the payment made by the assessee is in respect of an obligation incurred with the earlier flat agreement holder. So, if you had written the exact amount, you would not have caused any entry through profit and loss account. So, once anything is booked under profit and loss account, irrespective of the nature of nomenclature, it was said that it is liable for TDS. Assessee had essentially incurred an expenditure, and the amount of charges paid was with respect to the amount incurred by the flat agreement holder, and the period for which the money was so utilized by the assessee. The payment should be treated as interest under section 2 clause 28A of the Act, and it was liable for deduction of tax at source under section 194A. By the month of May or June first week, we have to give an estimate of investments which we will be making during the financial year. Based on that, they will work out the TDS and make deductions. And they give a cut-off date of December 15th or January 10th, by which time we are supposed to give proof for all the payments, all the claims which we are supposed to invest. So if we don't make any proof, they will no. If the form is, it will be prescribed. In the prescribed manner, we have to.
It's a computation, salary computation. Evidence evidence compulsory.
March payment March due date of March March
tax from 12.36 to 14%. The second thing, yes sir. So that is the first issue which comes to our mind is previously it was service tax, secondary and higher education cess. So 12 plus 2 plus 1, effectively it was 12. Effectively now up to tomorrow it is 12.36% only. Now the rate has been changed to 14%, subsuming the secondary and higher education cess. So all the cesses and service tax has been put together, it comes to 14%. We need not apply any separately any 2% or 1% to the rate of 14%. And when we make a payment of service tax, it is sufficient if we make the payment under the main head. Say for example, outdoor catering service tax or chartered accountancy service or whatever may be the service. We need not consider the code 0298 and 0426 for the secondary and higher education cess code. We need not consider from in respect of payment which we are going to make from 1st June and only for the services that are to be provided from 1st June. That is, so rate of tax is 14% including everything. The 2% cess which is introduced in the Finance Act, but it is not yet notified. That is Swachh Bharat cess. during the speech, the finance minister has told that 2% Swachh Bharat says they are proposing to levy on such services which they may notify. So that 2% says as of now is not yet notified. As and when it is notified, they will also tell the services, or they may include all the services also that we are not aware. For that services, 2% cess will be extra. That is another issue. Then from 1st June 2015, the new rate comes into force as the notification has already come. So here we will have a doubt for the transition period from 31/5 to 1/6. What should be the rate and how it should be collected. So here we are guided by point of taxation rules. Point of taxation rules, some 8 to 9 rules are there. So in that, rule 4 deals with point of taxation when there is a change in rate of tax. Now the rate of tax is changed from 12.36 to 14%. So the tax liability, how it arises is that in respect of services which are already completed by 31st May and the invoices which are already raised for the services, the rate remains 12.36 only, irrespective of the time when we realize the payment. So we might have completed service in 10th May, we have raised our bill today 30th May, we are likely to get our payment by November 2015. It is sufficient if we pay 12.36%. Similarly, if we have completed the service and received the payment also, it will hold good. We can make payment on 12.36. But we have completed our service by 31st May, but we have not raised the bill or received the payment, then 14% is applicable. If we are raising a bill on 1st June, we have to get service tax at the rate of 14% only. In respect of services which are to be provided from 1st June, services provided from 1st June, billing is raised thereafter, payment is received also after 1st June, there is no ambiguity, it is 14% only. But you have raised the invoices and the payment also received, then you can go with 12.36%. So these are the major issues with respect to point of taxation. Another important amendment brought out in this budget is that reimbursement of expenditure has been brought into service tax net. It was an ambiguity in service tax for quite a few years. Department was of the view that any reimbursement of expenditure, say for example while conducting statutory audit, we may claim a piece of some amount and we will claim TADA lodging, whatever the eligible amount, whatever the amount incurred separately. So now as per the amendment made in service tax, which is effective from 14th May 2015, that is the date on which we may kindly ensure the date on which the President has given assent. From that date, any reimbursement of expenditure which we are claiming, if we are a service tax assessee, we are supposed to claim service tax on it. Otherwise, we will be liable to pay service tax. Why there was an ambiguity in reimbursement expenditure and now how it is cleared? The issue behind that is the Finance Act 1994 does not deal with charging of service tax on the reimbursement of expenditure. Only the valuation rules says that reimbursement of expenditure is also liable to service tax. So the courts have held that the rules cannot override the provisions contained in the Finance Act. So the government was forced to amend the Finance Act and include in the section itself that any reimbursement of expenditure are liable to service tax. The only exception being pure agent. That concept is already in vogue. In respect of our clients who are making some payment which their client is under obligation to pay. Say for example, a lawyer they say they don't provide any service. we take any other service provider, if they make any payment on behalf of their customers and they produce the bill, the same amount, if they collect the same amount from their clients and make payment to the other party, and they've also got a consent from the customer stating that I hereby authorize you to make such and such payment for these purposes. Whatever be the expenses, I will reimburse you with no element of profit. That can be taken as reimbursement of expense. That will not come under the taxability of reimbursement of expenditure. Say for example, an engineer providing chartered engineer service, he charges for traveling, lodging or some other expenses, and also he makes payment of some 15,000 official payment to town planning authority for approving the layout or the drawing or design, whatever it may be. So if the client gives an undertaking or consent that whatever payment you make to the corporation or municipal authorities or LPDA, I will reimburse to you, then that amount need not be included under service tax liability. Other charges, even though that is incurred, say for example he is going to Chennai for it and incurs certain expenditure to get clearance of this project, he may incur travelling expenses, lodging, everything may be only in relation to providing this service, but those cannot be covered under pure agent. Pure agent should be backed by the bill, and the bill should be in the name of the customers only. So if he has any profit element in that, there also pure agent will not apply. If the other customer charges 2,000, other service provider charges 2,000, and we charge 2,500 from our customer, then pure agent concept will not work. We have to correct service charge on 2,500.
In our case, we are paying tax on behalf of the clients. Whether this comes under this
It is pure agent only. No, if you are, yes, that comes under pure agent. Pure agent.
In Kalyan law, the EV charges, that is started for service tax.
Yes, sir. It is covered under service tax, but I think most of the mandapams in Erode, they charge. No, sir. No, actually, what is the issue is that as far as mandap keeper service is concerned, the rent for the hall and all the expenses for which you are charging to the customer, we are supposed to pay service tax. But here, most of the mandaps, what they are doing is they declare only the rent. They declare only the rent. They collect service tax from the customer, but for the departments, they declare only the rent, maybe of a consolidated amount. I am not saying that they are charging more service tax from the customer and not paying to the government. But say for example, the rent is 1 lakh and other charges, cleaning charges, lighting, everything is EB, vessels, gas, everything is there. But they are not putting any breakup. And to the department, they are declaring only rent 1 lakh, service tax 12.36%. But 3 cases are selected on scrutiny on monthly basis by the department. And if our case comes in that, and if the person scrutinizing the case is shrewd enough, definitely they will land in trouble. And if they have already seen the mandap keeper's case in some other case, they will definitely apply the same principle. Even for the contractors, the persons who have vast experience in works contract, the superintendent or the assessing person, they insist for putting some value for the free water given by the person who is constructing the building. He may be a contractor, but it is there in the section. It is there in the provision. So, as far as mandap keeper service is concerned, we have to pay service tax on the gross amount. Thank you, sir.